In this series, I will review various ETFs that will give investors a better understanding of what exactly the ETF holds and the goal of the managing advisor. In this video, I will discuss VDY, Vanguard's High Dividend Yield Index ETF. VDY is traded on the Toronto Stock Exchange, also known as the TSX, under the ticker VDY.TO. The goals of this ETF are found under the highlights, with the first being to track and match the performance of the FTSE Financial Times Stock Exchange's Canadian High Dividend Yield Index before fees and expenses. The second is to employ a passive strategy that creates diversity across various market caps. And the last is to use cost-efficient indexing strategies to track the underlying index. To accomplish these objectives, the ETF holds common stock in Canadian dividend-paying companies. Vanguard makes it very easy to access the holdings list on the ETF's page. Scroll down to the holding details, and below the list we can export the entire list. If we take a look at how the ETF is broken up, we see that the top 6 holdings make up over 50% of the allocation, so an investor could hold these 6 holdings and get a similar exposure as the VDY. The name of this ETF is the High Dividend Yield Index ETF, so it is no surprise this fund gives out a generous yield of 4.5%. This is due to the types of companies VDY holds. For example, Canadian banks pay between a 3.1% and a 4.4% yield, and they are some of the biggest holdings in this ETF. The distribution has grown in most years except for 2016, and again, this is because the holdings regularly increase their dividend. So as long as the holdings continue on this trajectory, VDY should follow suit. The sector allocation for this ETF is heavy into the financials and energy, making up 80% of the total allocation of this ETF. Utilities, telecom, and basic materials make up the remaining 20%. A similar theme is seen with the large cap stocks making up over 92% of the total ETF. Creating large positions in large cap financials and energy in Canada has historically been profitable, especially when you include the growing dividends the sectors produce. In my opinion, this is the only area VDY does not meet its goals. They have allocated a large portion of its funds to large cap companies and provide little exposure to other capitalizations in the market. This is also understandable since the large cap companies VDY holds may have a more stable dividend. Together, VDY's stability and cash flow should produce predictable and consistent returns. This is for sure not a quick money maker, but it will provide opportunities to compound money. If you like this content and want another in-depth review of a particular ETF, comment your suggestion below. Be sure to like and subscribe.